Imagine waking up one morning to find your life's savings wiped out. For thousands of investors, this nightmare became a harsh reality when the cryptocurrency exchange, FTX, suddenly collapsed. But what really happened behind the scenes? Let's dive into the shocking story of FTX's rise and fall. FTX was founded in 2019 by Sam Bankman-Fried, a young and ambitious entrepreneur. With a background in trading and a vision for a more efficient cryptocurrency exchange, Bankman-Fried quickly gained the attention of investors. By 2021, FTX had raised over $1.8 billion in funding, with investors like Sequoia Capital and SoftBank pouring in millions. The exchange's valuation soared to $32 billion, making it one of the fastest-growing companies in the crypto space. But beneath the surface, warning signs were beginning to emerge. In an interview with Bloomberg, Bankman-Fried revealed that FTX's trading volume had grown by 1,000% in just 1 year, with revenues reaching $1 billion. However, the company's explosive growth was largely fueled by risky trading practices and a lack of regulatory oversight. As the crypto market continued to surge, FTX's user base expanded to over 1 million customers, with the exchange processing over $10 billion in daily trades. But the wheels were already in motion for a catastrophic collapse. In the months leading up to FTX's collapse, several red flags were raised by regulators and industry insiders. In a report published in June 2022, the crypto research firm, CryptoSlate, highlighted FTX's lack of transparency and questionable trading practices. The report revealed that FTX's proprietary trading arm, Alameda Research, had amassed a staggering $8 billion in liabilities, with the company's assets largely consisting of illiquid and volatile cryptocurrencies. Furthermore, an investigation by the blockchain analytics firm, Chainalysis, found that FTX had been secretly lending customer funds to Alameda Research, a clear breach of regulatory guidelines. As the crypto market began to decline in the second half of 2022, FTX's financial situation became increasingly dire. The company's cash reserves dwindled to just $1.5 billion, with liabilities exceeding $10 billion. Despite these warning signs, FTX continued to attract new investors, with the company raising an additional $400 million in funding just months before its collapse. On November 2, 2022, a bombshell report by the cryptocurrency news outlet, CoinDesk, revealed that Alameda Research's balance sheet was largely comprised of FTX's native token, FTT. The report sparked a wave of panic selling, with the price of FTT plummeting by over 70% in just 24 hours. As FTX's liquidity crisis deepened, the company was forced to freeze customer withdrawals, leaving thousands of investors stranded. In a desperate bid to stay afloat, FTX announced a potential bailout deal with its rival, Binance. However, the deal ultimately fell through, and FTX was left with no choice but to file for bankruptcy. The collapse of FTX sent shockwaves throughout the cryptocurrency market, with the price of Bitcoin falling by over 20% in the days that followed. The debacle also raised serious questions about the lack of regulatory oversight in the crypto industry, with many calling for greater transparency and accountability. In the aftermath of FTX's collapse, the cryptocurrency community was left reeling. Thousands of investors were left facing significant losses, with some losing their entire life savings. The debacle also sparked a wave of regulatory scrutiny, with lawmakers and regulators calling for greater oversight of the crypto industry. In the months that followed, several high-profile crypto companies filed for bankruptcy, including BlockFi and Celsius Network. The FTX collapse also had a significant impact on the broader cryptocurrency market, with the price of many coins falling by over 50% in the months that followed. As the dust settles, it's clear that the FTX collapse will have far-reaching consequences for the crypto industry, with many calling for a new era of transparency and accountability. The collapse of FTX serves as a stark reminder of the risks and uncertainties associated with investing in cryptocurrency, and the importance of doing your own research and due diligence before investing. So what can we learn from the collapse of FTX? Firstly, it's clear that the lack of regulatory oversight and transparency in the crypto industry is a major concern. The FTX debacle highlights the importance of doing your own research and due diligence before investing in any cryptocurrency or company. It's also crucial to understand the risks associated with investing in cryptocurrency, including market volatility and liquidity risks. Furthermore, the collapse of FTX serves